Welcome back to the Info Exchange channel.
Oh, glad to be back.
Today, we're taking a deep dive into something
Okay.
that, might not sound super exciting at first.
Yeah.
The IRS instructions for Forms 1040 and 1040 SRSR for the 2024 tax year.
Right.
But trust me, there is some
Oh, yeah.
seriously useful information hidden in these pages.
You might be surprised at
Yeah.
what you can find in here. We'll uncover
Oh, absolutely.
changes that could put money back in your pocket and maybe even a few aha moments along the way.
Absolutely. So let's unpack this.
Yeah.
We'll be looking at who needs to file,
Right.
what's new for this year, how digital assets play into all of this,
Mm-hmm.
and some potential ways to, save some money.
Yes.
Plus, we'll break down how to handle payments and refunds and where to get help if you need it.
Think of this like your cheat sheet to the tax code, highlighting what really matters for you.
Exactly.
You know.
So first things first,
Oh, okay.
let's talk about who needs to file a tax return this year.
Yeah, so the instructions lay out some basic income thresholds
Got it.
based on your filing status and your age.
Mm-hmm.
So for example, if you're single and under 65,
Right.
you'll need to file if your gross income is $13,850 or more.
Okay, so even if you're, not quite at retirement age yet,
Right.
you might still need to file based on your income.
Yes,
And I imagine those thresholds change again if you're married filing jointly.
absolutely. So for married couples filing jointly,
Right.
the threshold is $27,700 if both spouses are under 65.
Got it.
And if one spouse is 65 or older, that threshold increases to $29,550 and then jumps up again to $31,400 if both spouses are 65 or older.
So age definitely plays a role in those filing requirements.
It does.
Yeah.
But it's important to remember that these are just the basic incur thresholds.
Right.
The rules can get a little more complicated depending on your situation.
Mm-hmm.
For instance, if you can be claimed as a dependent on someone else's return, there are specific income requirements you'll need to meet.
Okay, and speaking of dependents,
Yes.
I found something kind of interesting in the instructions
Mm-hmm.
about married couples filing jointly.
Okay.
It turns out that even if you file jointly just to claim a refund, you could still be considered someone else's dependent.
That's right. It really highlights how important it is to
Yeah.
understand the dependency rules and make sure you're filing correctly
Mm-hmm.
based on your own personal circumstances.
Yeah.
And don't forget,
Right.
if you're a resident or non-resident alien,
Yeah.
there are specific guidelines for you as well.
Right. The instructions
Mm.
point to publication 519 for details on those situations. So
Yes.
if you fall into that category,
Okay.
be sure to check that out.
Definitely.
Okay, now let's get to some exciting news
Yeah.
for 2024.
All right.
The standard deduction amounts are going up for everyone.
It is exciting, yeah.
Yes.
More money in our pockets, right?
I love hearing that.
Yes.
So for single filers under 65,
Mm-hmm.
the standard deduction is going up to $13,850.
Yep.
And for those 65 and older,
Mm-hmm.
it's $15,700.
That's right.
If you're married filing jointly and under 65,
Mm-hmm.
the deduction's now $27,700.
Generous. Very generous.
Wow. That's a significant increase.
It is.
And it goes even higher for those 65 and older.
It does.
Right.
If one spouse is 65 or older,
Mm-hmm.
the deduction jumps to $29,550. And if both are 65 or older, it reaches $31,400.
Wow.
For heads of household, the standard deduction is $20,800 for those under 65 and $22,750 if you're 65 or older.
It's great to see these deductions increasing,
Mm-hmm.
especially, with the way things are going these days.
Right. Provides some relief.
It does.
And simplifies things for those who don't itemize their deductions. So
Right.
you can automatically take the standard deduction based on your filing status and age
Right.
without having to track, all those individual expenses.
Yeah, speaking of simplification, I read about another big change that's coming in 2025.
Yeah.
The direct file option.
Yes. Direct File will allow eligible taxpayers to file directly with the IRS online
Okay.
for free.
That sounds like a game changer.
It is a big change for those who prefer a more streamlined and secure way to file.
Right.
Mm-hmm.
Yeah.
So check it out. The instructions encourage everyone to check out directfile.irs.gov to see if they're eligible.
That's definitely going on my to-do list.
Yes.
I'm all about making tax filing
Wow.
easier.
Me too.
Another notable change for 2024 is an update to the surviving spouse election.
Mm-hmm.
Starting this year, a surviving spouse can be treated as the employee for required minimum distribution rules.
That's right. It could have some
Yeah.
major implications for retirement planning, especially for those who have recently lost a spouse.
Absolutely.
So the instructions reference publications 575 and 590 in IDB for more in-depth information on this.
Okay.
So if you're in that situation, definitely check those out.
Now, this next bit of information is specifically for those who might have been affected by certain disasters. The instructions clarify that relief payments
Okay.
related to the East Palestine train derailment and qualified wildfire relief are not taxable.
That's a huge relief for
Yeah.
those communities who have
Yeah.
already been through so much. It's good to see the IRS providing some support during those times.
I agree. And for those who are looking for more information about disaster relief,
Yes.
the instructions direct you to irs.gov disaster relief and publication 547.
Perfect.
Okay, now let's switch gears and talk about something that's been generating a lot of buzz lately.
Okay.
Digital assets.
All right.
Have you dabbled in crypto or NFTs at all?
Well,
Yeah,
got to stay ahead of the curve.
I know, right?
But seriously, it seems like the IRS is really starting to pay attention to this area.
Yeah, it seems like
The
it.
instructions are very clear. If you received or transacted with digital assets in 2024, you need to check yes on Form 1040 or 1040 SR.
Okay, so for the listener,
Mm-hmm.
what are some examples of actions that would trigger that yes box?
Think of it this way.
Okay.
If you received digital assets as payment for goods or services, that's a yes.
Okay.
Or if you received them as a reward or an award, that's a yes too. What about if you earned digital assets through mining or staking?
So that also goes in the yes column.
That's right.
Okay.
Basically, any interaction with digital assets, even if it seems minor, needs to be disclosed.
It seems like they're casting a pretty wide net here.
They are.
Yeah.
The instructions also mention the potential need to file Form 709 for gifts of digital assets,
Okay.
which can get a little more complicated.
Well, good thing the Form 709 instructions have all the details we need.
That's right.
Speaking of details,
Okay.
before we jump into the next section, I want to remind everyone that you can find even more valuable information on taxes and other fascinating topics
Yes.
by visiting our YouTube channel, youtube.com at the Info Exchange channel.
We cover a wide range of topics,
I do?
breaking them down in a way that's both informative and, hopefully entertaining.
Exactly. So be sure to subscribe and join our community of learners.
Yes.
Now let's get back to our deep dive.
Okay.
Up next, we'll be exploring credits and deductions
Right?
that could potentially save you some serious money come tax time.
This is where things get strategic.
Like it.
The instructions highlight several credits and deductions that can significantly reduce your tax liability if you qualify.
Okay, let's start with the child tax credit and credit for other dependents.
Okay.
These credits can be a game changer for families,
Mm-hmm.
but the eligibility rules are pretty specific, right?
Absolutely. So for the child tax credit, your child must be under 17 at the end of 2024.
Okay.
Have a valid Social Security number,
Right.
live with you for more than half the year, and be claimed as your dependent.
Okay, so all those factors need to be in place.
Yes.
And that Social Security number is key. The instructions emphasize that the child tax credit cannot be claimed without a valid Social Security number.
That's right.
And for the credit for other dependents,
Mm-hmm.
it applies to dependents who might not meet the age requirement
Right.
for the child tax credit, as long as they meet all the other dependency criteria.
That's right.
It's great to see the IRS offering support to families
It is.
with these credits.
Yes.
Now let's talk about the Earned Income Credit, or the EIC for short.
Okay.
This credit is designed to help those with lower incomes. The instructions even include a handy EIC table
Right.
and worksheets to help you figure out if you qualify.
It's incredibly helpful
Yeah.
for estimating your potential credit. The amount of the EIC is based on your income
Okay.
and the number of qualifying children you have.
Got it.
And don't worry, the instructions carefully walk you through those qualifying criteria.
They do. They even have a separate worksheet for those who don't have a qualifying child.
Right.
It's very comprehensive.
It is. It is.
The instructions also cover a number of other potential money savers. For example, there's the educator expense deduction,
Yes.
where eligible educators can deduct up to $300 for classroom supplies.
That's right.
And here's a bonus. They now include COVID-19 preventative supplies
Yes.
as eligible expenses.
That's right. It's a helpful update
Is it
for educators who have had to, adapt to these new safety protocols in their classroom.
Absolutely.
And there are other, deductions and credits to explore as well.
Yeah, like the student loan interest deduction, the self-employed health insurance deduction, the retirement savings contributions credit, also known as the saver's credit.
Yes.
Don't forget about the foreign tax credit.
Of course not. If you paid taxes to a foreign country, you might be able to claim a credit for those taxes on your U.S. return.
The key takeaway here is that there are many potential avenues for reducing your tax bill.
Don't leave money on the table.
Don't leave money on the table. That's right.
You work hard for it.
Exactly.
Now that we've explored some potential savings,
Right.
let's switch gears
Okay.
and talk about payments and refunds.
Okay.
The part everyone really wants to hear about.
Right. Nobody wants to owe more than they have to. And getting a refund is always a nice little bonus.
It is.
So let's break down how to handle those payments and how to track down that refund if you're expecting one.
So the instructions outline several ways to make your tax payments. You can use IRS Direct Pay, which is an online system that lets you pay directly from your bank account.
That sounds convenient.
It is, and secure.
Yeah.
You can also use debit or credit cards, but keep in mind that those come with fees charged by the payment processors.
So it's important to weigh the convenience against those potential fees.
Exactly.
And then there's also the option of electronic funds withdrawal or EFW, which is often offered when you file your taxes electronically.
That's right.
So many choices.
It's good to have options, though, right?
It is. It is.
Each payment method has its pros and cons, so it's important to choose the one that best suits your needs.
Right. And if you happen to overpay your taxes and are expecting a refund, the instructions have you covered there, too.
They do.
How do we track down that refund?
Okay.
Asking for a friend, of course.
Of course. The instructions point to irs.gov refunds
Okay.
or the handy IRS 2Go mobile app. You can check your refund status 24/7 with those.
Technology to the rescue. That's much easier than waiting for a check in the mail.
It is.
But I did read that if you're claiming the earned income credit or the additional child tax credit, you might have to wait a little bit longer for your refund.
That's right. The instructions state that refunds for those credits won't be issued before mid-February 2025.
Okay. It's always better to be prepared.
It is.
Speaking of being prepared, what about those of us who need a little extra help navigating the tax world? Where can we turn for information and assistance?
The instructions actually highlight a bunch of resources for tax help. So for those with low to moderate incomes or those who need extra assistance, there are free tax preparation services like Free File, VITA, and PCE.
Those services are amazing.
They are.
Having access to, trained volunteers who can help you, prepare and file your taxes accurately is such a lifesaver for so many people.
Absolutely. And there are even more resources available online.
Okay.
The instructions mention helpful tools like the EITC Assistant and the online EIN application, both of which you can find on irs.gov tools.
Okay, so let's break those down a little bit. What exactly does the EITC Assistant do?
So it's designed to help you figure out if you qualify for the Earned Income Credit. It walks you through the eligibility requirements and can give you an idea of whether you might be eligible for this valuable credit.
Sounds incredibly helpful. And what about the online EIN application?
That's for those who need to apply for an employer identification number, also known as an EIN.
Okay.
You'll need this if you're starting a business or hiring employees.
Okay, and both of these tools are free to use, which is fantastic.
They are, yes.
But what if you run into a more complex tax issue that you just can't solve on your own? Is there someone you can reach out to for help?
There is. The instructions recommend the Taxpayer Advocate Service, or TAS.
Okay.
They help resolve those tricky situations and make sure you're treated fairly by the IRS.
That's reassuring to know that there's a dedicated resource for those more complex issues.
It is. And before we move on, don't forget that you can find even more valuable information on taxes and other fascinating topics on our YouTube channel, youtube.com at the Info Exchange channel.
Exactly. We delve a little bit deeper into these topics and explore, a wide range of financial and business concepts.
We do.
You'll be amazed at what you can learn.
We're always uploading new videos packed with insights and tips.
Right. You won't want to miss it.
Yeah.
Okay, let's get back to our deep dive into the 2024 tax instructions.
Okay.
We've covered who needs to file, new changes for the year, digital assets, potential ways to save money.
Right.
We've even touched on payments, refunds, and where to find help.
But what happens despite our best efforts?
Right.
We make a mistake or miss a deadline.
Yeah.
It's important to understand the potential consequences of not filing or paying on time.
Nobody wants to think about penalties,
No.
but it's definitely better to be informed than surprised.
Absolutely. So the instructions are very clear about the penalties for late filing and late payment.
Okay.
And they can be quite hefty, involving both percentage-based penalties and interest charges.
So let's break it down. What happens if you file your return late? What kind of penalty are we looking at?
So the penalty is typically 5% of the unpaid taxes for each month or part of a month that your return is late.
Okay.
And that penalty can add up quickly with a maximum of 25% of the tax due.
Wow, 25%? That's a serious chunk of change.
It is.
And what about late payments? Is the penalty structure similar?
It is. The usual penalty for late payments is 0.5% of the unpaid amount for each month or part of a month that the tax remains unpaid.
Okay.
Again, this penalty is capped at 25% of the unpaid amount.
So those percentages can really add up.
It can.
It seems like filing on time, even if you can't pay the full amount right away, is crucial.
You're absolutely right.
And it gets even worse if you're really late. If you file more than 60 days past the filing deadline, the minimum penalty jumps to either $510 or the total amount of tax you owe, whichever is smaller.
That's right.
That's a hefty minimum penalty.
It is.
It definitely highlights the importance of taking those deadlines seriously. And it gets even more serious if the IRS determines that you filed a frivolous return.
Right.
What exactly does that mean?
A frivolous return is one that's deemed to be lacking necessary information or claiming deductions that are clearly not allowed. In those cases, you could be hit with a $5,000 penalty.
$5,000. That's definitely not worth messing around with.
No.
The instructions also mentioned other potential penalties for things like, negligence, substantial understatement of tax, and even fraud.
It's a reminder that taking your tax obligations seriously is crucial, but it's not all doom and gloom.
Okay.
The instructions also highlight your rights as a taxpayer. Did you know there's a taxpayer bill of rights?
I did hear about that. It's designed to, to ensure that taxpayers are treated fairly by the IRS.
That's right.
And outlines their fundamental rights throughout the tax process.
That's exactly right.
So you have the right to quality service in the IRS, meaning they need to treat you with respect and communicate clearly.
Yes.
That's reassuring to know.
It is.
And what about the right to pay only the correct amount of tax? Does that mean you can challenge the IRS if you think they've made a mistake?
Absolutely. You have the right to challenge the IRS's position if you believe they've made an error. And you have the right to appeal an IRS decision if you disagree with their findings.
So there are mechanisms in place.
There are.
To ensure fairness and accountability.
Yes. And don't forget the right to confidentiality. The IRS is legally obligated to protect your personal information.
It's empowering to know that we have these rights and that there are systems in place to protect us throughout the tax process.
Yes.
Now, we've talked about Forms 1040 and 1040-SR, but the instructions also mention Schedule 1.
Yes.
What was the purpose of that form?
So Schedule 1 is where things get a little bit more detailed. You use it to report additional income and adjustments to income that can't be entered directly on your main tax form.
So it's like an addendum.
That's a good way to put it. Yeah, to your main return, capturing those, extra details.
Right. For example, if you received a Form 1099-K for payments you received through, third-party payment networks. But some of those payments were for personal items you sold at a loss. You'd report that information on Schedule 1.
You would.
Okay, so if I sold my old bike online for less than I originally paid for it, I would report that loss on Schedule 1.
Exactly.
Okay.
The instructions have a dedicated entry space at the top of Schedule 1, specifically for this purpose.
Got it.
They even give helpful examples of how this works in different scenarios, like if you sold multiple items with a mix of gains and losses.
It sounds like they've thought of everything.
They try to.
Yeah.
Now, let's look at some specific lines within Schedule 1. Line 1 deals with taxable refunds, credits, or offsets of state and local income taxes.
Okay.
So this can get a little tricky because you might have received a refund of state or local taxes in 2024, and you might be wondering if any of that refund is taxable on your federal return.
So how do you figure that out?
Well, the good news is that if you didn't itemize deductions in the year you paid those state or local taxes, none of your refund is taxable.
Okay.
And if you chose to deduct state and local sales taxes instead of income taxes, you're also in the clear.
Okay, so pretty straightforward.
It is.
In those situations. But what if you did itemize deductions? What happens then?
Then you'll need to do a little more digging.
Yeah.
But don't worry. The instructions provide a worksheet to walk you through the process of determining the taxable portion of your refund.
It's a lifesaver.
Yeah.
And it sounds like they try to make these potentially confusing situations as clear as possible.
They do. They do.
Okay, now let's jump to lines 2A and 2B.
Okay.
Which deal with alimony received.
Right.
This is an area where, the tax laws have changed.
Right.
In recent years.
They have.
So it's important to pay attention to the details.
It is.
So what are the current rules regarding alimony and how it's treated for tax purposes?
So if you received alimony payments under a divorce or separation agreement that was signed on or before December 31st, 2018, you generally need to include those payments in your income.
That makes sense. It's considered income for the recipient.
But there's an exception.
Okay.
If that agreement was modified after December 31st, 2018, to specifically state that the alimony is not considered income, then you don't have to report it.
So those modifications can really change things.
They can. And if you entered into a divorce or separation agreement after December 31st, 2018, any alimony you received under that agreement is not taxable income.
That's a significant change from the previous rules.
It is. And it highlights the importance of, staying up to date on tax law changes, especially when it comes to, major life events like divorce.
Right.
The instructions also emphasize that if you are including alimony in your income, you need to provide your Social Security number to the person making the payments.
So both parties are on the same page.
Exactly.
When it comes to reporting.
Right. And remember, if you don't provide your Social Security number, you could face penalties.
Okay, now let's skip ahead to line 8V.
All right.
Which focuses on those digital assets we discussed earlier.
All right, so this line is specifically for reporting ordinary income from digital assets that you haven't reported elsewhere on your return.
Got it.
So think about income you might have received from fork staking or mining activities.
That makes sense.
Right. But it's important to note that this line isn't for reporting digital assets received as a gift or inheritance.
Right.
Those have their own set of rules and are reported elsewhere on your return.
Good to know.
It is.
It seems like the instructions do a good job of breaking down these different scenarios and making it clear where to report each type of income.
They do. And they also emphasize that if you're looking for more information on the tax treatment of digital assets, the IRS website has a dedicated section that can, answer any questions.
Okay.
It's irs.gov businesses, small businesses, self-employed digital assets.
Okay. That's a valuable resource for anyone navigating this world of digital assets and taxes. Now let's move on to Schedule 1, Part 2.
Okay.
Which covers adjustments to income.
Right.
So I know these adjustments can lower your taxable income and ultimately reduce your tax bill.
Right.
Are there any specific adjustments that stand out or might apply to, a wide range of taxpayers?
There are quite a few potential adjustments listed.
Okay.
So let's focus on a few key ones.
Okay.
Line 12 covers the educator expense deduction, which is pretty straightforward. If you're an eligible educator, you can deduct up to $300 of qualified expenses you paid for classroom supplies.
And as we mentioned earlier, the instructions now include COVID-19 preventative supplies as qualified expenses.
That's right, which is a helpful update for educators.
Absolutely.
Line 14 covers moving expenses.
Okay.
But the deduction for moving expenses is now limited to members of the armed forces on active duty.
Okay.
Who move because of a permanent change of station.
So unless you're in the military,
right? Yeah.
You likely can't claim this deduction.
Right. But if you are eligible, the instructions direct you to publication 46801 for more information.
Got it. Now let's jump to line 17.
Okay.
The self-employed health insurance deduction.
All right. This one can be a big help for self-employed individuals and small business owners who have to pay for their own health insurance.
Right.
But there are specific requirements you need to meet to qualify.
Right.
So you need to be self-employed.
Okay.
And have a net profit for the year from your business, as reported on Schedule C or Schedule F. Or you could be a partner in a partnership with net earnings from self-employment. The key point here is that you can't deduct health insurance premiums.
Right.
If you were eligible to participate in an employer-sponsored health plan for any part of the year.
It's all about making sure you meet those eligibility requirements.
Right. And if you're dependent or a child under 27 was eligible for a subsidized health plan through their employer, you can't use the amounts you paid for their coverage to calculate the deduction either.
So it's important to consider all those factors.
It is.
When determining your eligibility.
Absolutely. And don't worry. The instructions provide a worksheet to help you figure out how much you can deduct. Line 19 deals with alimony payments. You made. Which is essentially the flip side.
Of the alimony we discussed earlier.
So if you made alimony payments under a divorce or separation agreement, signed on or before December 31st, 2018, you can generally deduct those payments on your tax return.
That's correct. But just like with receiving alimony, the rules change. If the agreement was modified after that date, so if the agreement was modified after December 31st, 2018, to specifically state that those payments are not deductible, then you can't claim the deduction. And if you entered into a divorce or separation agreement after December 31st, 2018, you can't deduct any alimony payments you made under that agreement.
It seems like that December 31st, 2018 date is a crucial one to remember.
It is.
When it comes to alimony.
It is.
And just like when receiving alimony, the instructions point out that you need to include your former spouse's Social Security number.
That's right.
On your return when claiming the alimony deduction.
That's for proper record keeping. And to ensure the IRS can match the deduction with the reported income on your former spouse's return, right?
Exactly.
Now let's tackle a topic near and dear to many of us. Retirement savings. Line 20 on Schedule 1 is all about the IRA deduction. Which can lower your taxable income by contributing to a traditional IRA.
That's right.
But there are some rules to keep in mind. Not everyone can just deduct their IRA contribution.
That's right.
So first and foremost, you need to have earned income to qualify for the deduction.
You do.
And the instructions define earned income pretty broadly for IRA purposes, right?
They do. It includes not only wages and salaries, but also alimony payments reported on Schedule 1, Line 2A. And if you're a member of the U.S. Armed Forces, your non-taxable combat pay also counts as earned income.
Got it.
For this purpose.
And for self-employed individuals, their earned income for IRA purposes is generally their net earnings from self-employment, as long as their personal services were a significant factor in generating that income.
Exactly. Now, the amount you can deduct depends on several factors, including your age, filing status, and whether you or your spouse were covered by a retirement plan at work. The instructions provide worksheets to help you navigate these roles and determine your maximum deduction.
Those worksheets can seem a little daunting at first glance.
They can.
But they really do, break down the process step by step, making it more manageable.
They do. It's just a matter of, carefully reviewing the instructions and gathering the necessary information.
Yeah. And remember, even if you can't deduct your entire IRA contribution, it's still a valuable way to save for retirement.
It is.
The The earnings on your IRA contributions grow tax deferred.
That's right.
So you don't pay taxes on those earnings until you withdraw them in retirement.
Right.
That tax deferred growth is a huge benefit.
It is.
Let's move on to line 21.
Okay.
The student loan interest deduction.
All right. This deduction can be helpful for those paying off student loans.
Right.
But I imagine there are, specific requirements for this one as well.
Right. So to qualify, the loan needs to be a qualified student loan, meaning it must have been taken out to pay for qualified education expenses.
Right. And those expenses typically include things like tuition, fees, room and board, books, supplies, and equipment required for, enrollment or attendance at an eligible educational institution.
Right. And you can't be claimed as a dependent
Right.
on someone else's tax return. The deduction is also phased out for those with higher incomes.
It is.
So it's important to check, the income limits.
Yes.
To see if you qualify.
The instructions lay out those income limits based on your filing status.
Right.
So it makes it easy to check your eligibility.
Right.
And they also emphasize that you can't deduct student loan interest paid with funds from a tax-advantaged savings plan, like a 529 plan or a Coverdell ESA.
Good to know. So many details to keep in mind.
There are.
Let's move on to Schedule 2, which covers additional taxes you may owe. The schedule can seem a little overwhelming.
It can.
Since it covers such a range of taxes.
It does, but remember, not every line will apply to everyone.
Right.
It's all about figuring out which lines are relevant to your own financial situation.
So it's about finding what applies to you and focusing on those details.
That's it.
Okay, let's highlight a few lines that might be of interest to a broader audience.
All right.
Line 5 covers the additional Medicare tax, which seems to be popping up more these days.
It does.
What exactly is the additional Medicare tax, and who does it apply to?
So the additional Medicare tax applies to earned income above certain thresholds.
Okay.
It's designed to help fund Medicare, the federal health insurance program, for those 65 and older.
Right. So if your wages, compensation, or self-employment income exceeds $200,000, you'll likely owe this tax.
That's right. So it's for those with higher incomes. Okay. And for those married filing jointly, the threshold is $250,000.
Okay.
If you're married filing separately, the threshold is $125,000.
So if your income exceeds these limits, you'll need to pay a little extra for Medicare.
That's right.
But is this something you have to calculate on your own, or is it, taken care of automatically?
So the good news is that your employer will usually withhold the additional Medicare tax from your paycheck.
Got it.
So you don't have to calculate it yourself.
That definitely simplifies things.
It does.
Now let's move on to line 8.
Okay.
Which covers tax on early distributions. This one can catch people off guard.
It can.
Especially those who aren't familiar with the rules regarding retirement plan withdrawals.
Right. Essentially, if you withdraw money from a qualified retirement plan before you reach age 59 and a half, you could be hit with a 10% early withdrawal penalty. In addition to your regular income tax liability.
A 10% penalty, that's significant.
It is, but there are some exceptions with this rule. The instructions list several exceptions, such as withdrawals for, certain medical expenses, disability, and even first-time home purchases.
Okay, so there are situations where you can access those funds early without facing a penalty.
Exactly. If you're facing a situation where you need to tap into, your retirement funds early, it's worth checking if you qualify for any of those exceptions.
Good advice. Better to be safe than sorry, especially when it comes to retirement funds.
That's right.
Okay, let's jump ahead to Schedule 3, which focuses on non-refundable credits. So I know these credits can reduce your tax liability, but they can't reduce your tax below zero, right?
That's right. They can't result in a refund. But they can certainly help lower your overall tax bill.
Okay, line 12 is one that might be relevant to a lot of people, the foreign tax credit.
Right.
So if you pay taxes to a foreign country, you might be able to claim a credit.
You might.
For those taxes on your U.S. return.
It's a way to avoid being taxed twice on the same income.
Right, and it can be a valuable credit.
It can.
Especially if you have significant foreign income.
Right, and the instructions explain how to calculate the credit and what documentation you need to provide.
And if the amount of foreign taxes you paid exceeds a certain limit, you might be able to carry over the excess credit to future tax years.
That's right, so it allows you to potentially benefit from the credit, even if you can't use it all in the current year.
That's a helpful provision.
It is.
Okay. Now let's move on to a topic that can be a bit sensitive.
Okay.
Identity theft. It's a serious concern these days.
It is.
And it's scary to think that someone could steal your personal information.
Right.
And use it to file a fraudulent tax return in your name.
It is a serious issue.
It can have, devastating consequences, potentially delaying legitimate refunds, or even resulting in you owing taxes that you don't actually owe.
Right.
So what can we do to protect ourselves? Are there any preventative measures we can take?
So the instructions highlight a program called the Identity Protection PI, or IPPI for short.
Got it.
This is a 6-digit number that the IRS assigns to you to help verify your identity when you file your tax return.
So it's like an extra layer of security.
Exactly. Yeah. So you can apply for an IPPI online through the IRS website. Or you can file Form 15227 by mail.
Got it.
The instructions provide details on both methods. And once you have an IPPI, you need to include it on your tax return every year.
So it's an extra step.
It is.
But it's a small price to pay for, peace of mind.
Right.
That comes with knowing you're doing everything you can to protect yourself from identity theft.
That's right. The instructions also emphasize being aware of phishing scams.
Right. The IRS will never initiate contact with you through email, text messages, or social media.
That's right.
To request personal or financial information.
Exactly. So if you receive a message that seems suspicious, don't click on any links. Or provide any information. Report it to the IRS immediately.
It's always better to err on the side of caution.
Absolutely.
When it comes to protecting your personal information. Okay, let's shift gears. And talk about the many resources and assistance available to taxpayers.
Right. The IRS offers a wealth of resources to help you navigate the complexities of the tax system.
I know it's not always easy to find what you need.
Right.
But the instructions do a good job of pointing you in the right direction.
They do. So we already mentioned free tax preparation services like Free File, VITA, and TCE, which are fantastic resources for those who qualify.
Right. But what about other types of assistance, like online tools or in-person help?
So the instructions mention a few helpful online tools, like the EITC Assistant and the online EIN application, both available on irs.gov tools. Those are both great resources, but the IRS also has taxpayer assistance centers, or TACs, located throughout the country.
Got it.
These centers provide face-to-face assistance with tax issues.
So if you prefer in-person help or have a complex issue that requires, one-on-one assistance, the TACs are a valuable resource.
They are. You typically need to schedule an appointment in advance. But the instructions provide a website, irs.gov tech locator, where you can find the nearest TAC and check their hours of operation.
It sounds like the IRS is really trying to make help accessible.
They are.
Whether it's, online, over the phone, or in person.
And if you need help with a, specific tax issue, the IRS website has a wealth of information on various tax topics. You can find answers to frequently asked questions, access tax forms and publications, and even download the IRS To Go mobile app, which puts useful information right at your fingertips.
It sounds like they've covered all the bases.
They have.
But what happens if you can't pay your taxes in full?
Right.
That's a situation that many people face at some point.
You do.
And it can be incredibly stressful.
It can.
So the instructions do provide some guidance on what to do if you find yourself in that situation.
They do.
So what's the first step? Do you just ignore it and hope it goes away?
Definitely not. The first step is to file your tax return on time. Even if you can't pay the full amount due.
Right.
Failing to file on time can lead to penalties and interest charges, making the situation even worse.
So filing on time is crucial.
It is.
Even if you can't pay the full amount immediately.
That's right. Once you've filed, you can explore options for resolving your tax liability. The instructions mention a couple of possibilities, like an installment agreement or an offer in compromise.
Okay, so let's break those down a little bit. What exactly is an installment agreement?
An installment agreement allows you to pay off your tax debt in monthly installments, which can, make it more manageable.
That sounds like a helpful option.
It is.
And what about an offer in compromise? How does that work?
An offer in compromise allows you to settle your tax liability for less than the full amount you owe. But both options have specific eligibility requirements. So it's important to carefully review the instructions and consult with a tax professional if needed to determine the best course of action for your situation.
It's good to know.
It is.
There are options available for those who might be struggling to pay their taxes.
Right. And I imagine the IRS is generally willing to work with taxpayers who are making a good faith effort to resolve their tax debt.
The key is to be proactive and communicate with the IRS about your situation.
I don't try to hide or ignore the issue. Open communication is essential.
That makes sense.
Now, before we wrap up our discussion of Schedule 1. Let's revisit the Taxpayer Bill of Rights. We touched on it earlier, but it's worth emphasizing those fundamental rights that every taxpayer has.
It's so empowering to know that we have these rights.
It is.
And that the IRS is obligated to respect them.
They are.
So remind us again, what are some of those key rights?
So first, you have the right to be informed. That means the IRS needs to communicate with you in a clear and understandable way, explaining, your rights and responsibilities as a taxpayer. You also have the right to quality service, meaning the IRS should be courteous, professional, and timely.
Those are fundamental rights in any interaction.
They are.
But especially when dealing with something as important as taxes.
Absolutely.
What about the right to pay only the correct amount of tax?
That's a big one. It means if you believe the IRS has made an error, you have the right to challenge their assessment and provide documentation to support your position. And if you disagree with their decision, you have the right to appeal that decision to an independent forum.
So there are checks and balances. There are.
And don't forget the right to privacy. The IRS must protect your confidential information and only disclose it as authorized by law. These are just a few of the key rights outlined in the Taxpayer Bill of Rights.
It's a great reminder that we have rights and that the tax system isn't just about obligations, but also about fairness and accountability.
That's right. Let's get practical and talk about how to file your tax return. So the instructions provide clear guidance on where to file and what to send.
It seems like having all the necessary documentation organized is the first step.
It is. That includes your Social Security number or your individual taxpayer identification number, as well as all your income statements like Forms W-2 and 1099. You'll also need any documentation that supports the deductions and credits you're claiming, like receipts for charitable contributions or documentation for medical expenses. Accurate record keeping throughout the year is crucial. It makes tax time so much easier.
I can imagine trying to gather everything at the last minute would be a nightmare.
It worked.
Once you have your documents in order, you you need to choose a filing method.
That's right.
You can file electronically, which is generally the fastest and most secure method.
Yes.
Or you can file by mail using the paper forms provided by the IRS.
You can.
So you have options there as well.
You do.
If you're filing by mail, the instructions include a table that shows the appropriate IRS mailing address based on your state of residence and other factors.
That's right.
So using the correct address is important to avoid delays in processing your return.
Absolutely. And make sure you sign your return and include all the required forms and schedules before we move on to the final section of the instructions.
Let's remind everyone about another amazing resource for even more in-depth information on taxes and other, fascinating topics. Visit our YouTube channel at youtube.com/the-info-exchange channel.
We have a whole library of videos covering everything from
basic
tax concepts to advanced strategies.
That's right. We're constantly uploading new content. So subscribe to stay up to date.
Right.
And join our community of learners.
Okay, let's dive back into that final section of the instructions, which covers some important details about penalties, interest, and your rights as a taxpayer.
Right. We've already discussed some of these topics, but it's always good to reinforce this important information.
It's all about making sure we're informed and prepared for whatever tax season throws our way.
That's right.
It feels like we've covered
so much ground already.
We have. We've hit on, the major points.
Right.
But it's crucial to remember that these instructions are just a starting point.
Right.
They give you, a solid overview of the tax rules and procedures, but there's always more to learn.
So it's kind of like a roadmap, but you might still need a guide to help you navigate the twists and turns.
Exactly. If you have a complex tax situation, or you're just not sure about something, it's always best to consult with a qualified tax professional.
That makes sense. They can offer personalized advice based on your specific circumstances.
Absolutely. They can help you navigate the complexities of the tax code and make sure you're taking advantage of all the deductions and credits you're entitled to.
It's like having a tax expert in your corner, advocating for you and helping you, make the best financial decisions.
Exactly. And don't forget that tax laws are always evolving.
Right.
So staying informed about any changes is crucial.
Right. So it's not a set it and forget it kind of thing.
Not at all.
Okay.
The IRS website is a fantastic resource for, keeping up to date.
Right.
You can sign up for email alerts from the IRS and even follow them on social media.
Wow. I didn't realize the IRS was on social media.
They are. Oh. It's a surprisingly good way to stay informed. They share helpful tips and reminders, especially during tax season.
That's good to know.
It is.